Hi everyone, I'm Roy Güllüoğlu. Welcome to our global financial markets update video. Today we'll dive into key data shaping market prices. We have received the latest PPI, CPI and retails data from US, and PPI and CPI offer insights on inflation, and retail sales data give hints about economic activity, which has become main focus of financial markets. The UK also saw a flurry of data, including job market figures, CPI, GDP, and retail sales. UK employment dropped unexpectedly, indicating a strong economy. The jobless rate fell to 4.2% for 3 months ending in June. Companies are hiring faster than expected and with less concerning economic activity. GBP remains the top performing major currency this year, largely due to expectation that the Bank of England will maintain higher rates compared to other central banks. We'll also today keep an eye on euro short covering activity, potential euro dollar long trade idea that I have provided last week. Finally, we'll examine some global economic trends through lens of oil prices, because oil is like the source of the real economy. That's why it has some role to if the oil prices are so high, the costs are so high, and that's how we assess the economic growth actually. That's why oil prices are pretty important. So let's dig in. First of all, headline inflation. We received the inflation data. Here in this chart, you see sticky price CPI. Before that, headline inflation has fallen below 3%, now close to Fed's target range. The index for shelter rose 0.4% in July, accounting for nearly 90% of the headline number in the monthly side. In the core inflation side, the annual increase is 3.2%, the lowest since April 2021. The annual change supported deflationary trend. That's good news. Now inflation is all about core services side. In core services, the annual change decreased from 5.1% to 4.9%. That's good news again. Goods inflation has turned negative, and the spikes in fuel and food prices seems like over. In the core goods sector, the annual change shows deepening deflation. That's all good side. A very important measure from the Atlanta Fed. This is the sticky CPI. This focuses on generally goods whose prices are slow to change. That's why it's called sticky. And any progress on this side, that's really good sign in the path of disinflation. So as you can see in this chart, this blue line, it's decreasing. That's also 3-month annualized version decreases as well. That's all good signs. The it has it has increased at annualized rate of less than 3%. And here in this chart you see Cleveland Fed's trimmed mean and median inflation. The Cleveland Fed also looks at inflation by averaging out middle range of price changes, ignoring the extremes. By ignoring the extremes, it provides you more like a clear picture about the current state of the inflation. So this is called Cleveland Fed trimmed mean inflation. These measures haven't dropped 3% yet. As you can see, the trimmed mean just around 3%, and median is around 4%. While that's not a great news, the overall a trend still remains still seems to be heading in the right direction for what the Fed wants actually. So if there is a real reason to be concerned about progress on disinflation, it's coming from the housing market. As I mentioned at the beginning, the 90% of the headline number in the month over month sourced by shelter side. So in July, shelter price inflation increased along with the super core inflation here That's what you see in this chart. This black line is called core services inflation less housing, is called super core inflation. It was like one of the most important measures that Fed was monitoring, because since they know that the progress on shelter inflation is expected to be lagged, they were looking for more clear picture on inflation. And if you take the housing side, and the service side was the problematic, so core service minus the shelter side gives more clear picture. That was a bit concerning actually, but it's important not to overreact. Just 1 month's data that was the, I think, main reason that we didn't see any huge positive price action just after the data. Let me show you. Let's quickly check what happened at just after the data in, for example, let's say S&P 500 chart. It was last Wednesday. As you can see, like it closed like a minus 0.74%, because market mainly currently like focusing on this super core, and having a spike on that side was a bit concerning. Market took it serious actually, but after Wednesday, on Thursday we received retail sales data. That was pretty important in order to assess the state of consumer spendings actually. So how are we going to assess economic activity? First of all, through non-farm payroll data. That's the most important one for sure. With that, we need to focus on consumer confidence indices. Apart from that, retail sales data gives a hint on economic the consumer spendings. That's why it was important, and we received like a good data, and good data led to good pricing, and like it kind of covered the downside that we had from the super core inflation. So let's come to the euro side. The euro USD, as I mentioned in our previous market update video, we discussed the potential euro USD long trade idea that has already been triggered, and currently while I'm recording this video, it's moving really good. I'll show you a bit later. If the price action, in order to assess if this price action is healthy, I mean, we need to closely observe the activity on this attached chart actually, because it's like the white line chart is leveraged position, and as you can see, it's in the negative territory right now. As we see an increase in this side, that means short positions are decreasing. So any increase in this white line means that shorts started to be covered. So with that, as you can see, with this covering, as you can see, the blue line euro USD is increasing here. So traders are expecting the Fed to cut interest rates more aggressively than the European Central Bank in the coming months, thanks to the progress on disinflation in US, despite the euro's recent rise over the past two months. Leverage positions are mainly still short on the euro, as you can see in this chart. So here still negative territory. So yeah, this actually suggests that there still might be more room to go, because first they're gonna switch to the positive area, and we might expect more important price action when this leverage position gets into the positive territory. So yeah, and also here in this table you see the economic calendar that we here, if you follow this, if you follow MarketSol Twitter account, actually we're putting the link just below the video. You can find from there. It's keep being posted, this forecast, all the data flow that is expected to released every week. So that might help if you're actually like a data dependent trader, or if you have that kind of trading mentality. So overall, in order to wrap up what's going on in the current market, so last week's economic data confirmed that consumers are still spending, the labor market remains strong, like small businesses are doing well, and inflation continues to moderate. So the upcoming week is light on economic data, but Jackson Hole will play a crucial role. On Friday, there's going to be Fed's Powell speech, and we're going to receive the FOMC meeting minutes on Wednesday. It will be released on Wednesday, and that will provide some insights on Fed members' view. Additionally, existing home sales and new home sales data will be crucial in order to see the lagged impact of high interest rates on housing markets. Now, let's flip through a few charts that I would like to show you. Here, first of all, let's start with euro dollar. As you can see, daily it's 0.4% high right now. The first reaction might come at 1.1140 levels, and this was the trade idea that we had provided last week, and because it's actually breaking out like this symmetrical triangle, but at the same time there's a head and shoulder bottom chart pattern is broken out here, and the trade idea that we had provided, as far as I remember, like buying from here and just stop below this level. So as you can see, like with the potential, let's say, I don't know, the price target of HNS bottom, it provides 1 to 2.4 risk reward ratio, which is pretty nice actually. And yeah, weekly picture is like this. And another one that we provided was gold trade idea, being long around here with a tight stop, and still I preserve my my idea that any potential correction in gold should be benefited as buying opportunity, because as you can see, it's diverging from short-term moving averages, and it will be pretty normal to see some pullback to the short-term moving averages, and that might be another option. Just don't rush here after the I think like non-farm payroll data. The Fed rate cut expectation until the end of this year went to 5 rate cut or something, but currently it's around 3 rate cuts, I guess. I think that's much better in order to see some healthy price actions, because any potential expectation on 5 rate cut would imply also Fed afraid of potential recession or potential economic downturn in like a real economy side. That's why they're rushing that much, and in that scenario we would see more like a panic sells or something, and that will be like, it doesn't. So just I'm trying to say that it doesn't mean like always okay, yields are coming down, rates are expected to cut more than expected, okay, like I don't know, risky assets, long duration assets, golds are gonna perform well. No, it should be like a balanced. It should be like a if as long as market thinks that everything's like more or less under control in terms of economic activity and inflation, we would see more healthy price action. So yeah. One other chart that I like to show you is, first of all, let's focus on this symmetrical triangle chart going on oil. And first, a week ago actually, we had seen this largest weekly increase in oil when OPEC Plus announced supply cuts due to falling prices. This rise actually occurred despite OPEC Plus lowering its demand projections due to the global slowdown. The price approached its 200-day moving average. Here, I'm talking about this move, this increase. Yeah. And then like this actually suggests that market isn't anticipating any like major risks. If oil prices were to spike sharply, it would directly affect US politics actually through gasoline prices, because gasoline prices are one of the major key determinants in US elections generally, since like people frequently refuel and are consistently reminded of gas prices by road signs. Any significant increase would be highly noticeable, and it's politically sensitive. So currently gas prices are still slightly like declining. There's nothing to concern right now, and as you can see, like it's coming down. That's why like the first time that I mentioned oil chart, the price was around here. We didn't see any breakdown. That's why actually the trade idea that we provided was not triggered. But any potential breakdown from here still be like I don't know, like I need to see the action from here. Accordingly, I will be deciding the stop. But generally, I'd like to apply tight stop in an uncertain environment, because I would like to be out of the trade as quick as possible with the mentality of opportunity cost. And yeah, still I'm preserving this potential short trade idea in oil. Apart from the symmetrical triangle, when we come to the weekly chart, as you can see here, it's not a perfect shape, but here at the same time it's establishing a head and shoulder top chart pattern formation, which is also a bearish chart pattern. So combining these two technical sides and having in my mind that higher gasoline prices would be a risk on US election for the near future, I don't see that much upside room for crude oil prices. That's why if I were to trade crude oil, shorting would be my priority, and I will be shorting this potential breakdown. And another chart that I would like to show you is Meta platform. It's not like a perfectly shaped, but there's a, like, you can call it maybe like ascending triangle chart pattern. It's a bullish chart pattern. So we received like I think at the end of July the Meta Q2 earnings. There were like a three key takeaways. First of all, artificial intelligence advantage. Meta is leveraging AI more effectively than its competitors to generate additional revenue from its existing business, especially advertisement. Second one is 2024 capex update. Meta revised the lower end of its capex range. The capex range was 35 billion to 40 billion, and they revised the lower band to 37 billion. That means that they are expecting more revenue from artificial intelligence side, so they're increasing this their investment on it. And about 2025 outlook, the CFO emphasized that investments will continue in 2025, indicating like a ongoing commitment to growth and innovation. And yeah, if I were to trade Meta, I would be that this ascending triangle chart pattern would be the game. As you can see, also earnings side is like a positive. always. I would like to see increasing quarterly earnings. Like each quarter, I would like to see higher number in order to behave, in order to treat to Meta as a exact growth company. But it's not growth company right now. Currently, I mean, back in time it was, but now it's the environment has changed actually, because main technology companies actually behaving like a value companies because they're generating huge revenues. And yeah, like back in like 2021, I guess, during the COVID time, there was a huge dispersion between value trade and growth trade. I think that distinction is not that clear in the current environment. But yeah, let me let me come back to the chart. Yeah, and one other chart that I would like to show you is SHY ETF. It is 1 to 3 year. That means like a short-term treasury bond ETF. As long as this chart goes on the up, that means yields are coming down. If you want to bet on yields to come down, it's a good option to trade. In the weekly chart, first touch, second touch, third touch, fourth touch, a pullback maybe, and we would like to see that kind of price movement in order to see a healthy price action. Another one, Walmart. Last week we received earnings, and after the earnings there's a huge earning gap, and we're above all moving averages right now. It shows the strength of consumer activity actually. And this week we're going to receive target. In the target, when you come to weekly, a potential gap up scenario as we observed in Walmart would lead to establish a HNS bottom chart pattern formation. And yeah, in overall, that's another way to also monitor economic activity. And yeah, that's all I'm going to talk about this week. Thank you for your time, and thank you for listening. If you like whatever you hear in these videos, please subscribe, please share, and if you have any question, please leave us a comment below. We would glad to answer all your questions, and have a great week. Thank you.